It's time now for the word on Wall Street. Top investors watching your money. Joining me now, Wealth Consulting Group CEO Jimmy Lee. Also with me is Mark Tepper. Jimmy, let's go ahead and start with you on this one, taking a look at futures right now and where the markets stand. Obviously, this move yesterday to buy back long-term treasuries by the Treasury Department, sending yields a little bit lower, lifting the stock markets. Is this a trend that you expect to see last, or was it just a short-term fix?
Well, I think it's actually a short-term fix, but it's a good short-term fix, and it's showing the investor community that the Treasury has tools to be proactive about what's going on with yields. And I think the longer-term investors are more concerned about the $40 trillion of debt, national debt that we have.
We crossed that line, and that is breaking news, not that we weren't expecting it. Can I just ask you about Moderna and Merck? They're a little lower this morning, but obviously they had a big rally yesterday, actually leading the markets. They announced a trial success on a new melanoma vaccine. Moderna soaring nearly 177%. It was the best day on record. All this as we're waiting for Walmart's second quarter earnings out at the top of the next hour. What do you think?
Certainly, I mean, I think we're going to see some amazing advancements, with medicine, and that news was phenomenal for people, all of us. As far as the consumer, we had a soft report in July that I don't think is really representative of how resilient the consumer really is, and that's very important because nearly 70% of GDP is due to consumer here in the United States. And, consumers are still spending, and they're being very resilient, like, as I said, even with higher gas prices. And so if we can get oil prices to come down, if we can get this war to get resolved, then I think we could potentially, get consumer confidence to go up, and maybe even get some animal spirits and a feeling of that. And I believe that we can get new market highs, maybe even much higher than where we're at today.
Yeah, let's take a look at where we stand with yields this morning, Mark, because, again, you had that move by the Treasury yesterday. That lifted the markets. Fed minutes were out. The indication seems to be that a hike would be necessary if the situation overseas isn't resolved because of what it's doing to oil prices. So the yields are slightly higher this morning, 4.67 on the 10-year. 5.2 on the 30-year. So this notion that we're thinking about what's going to happen with rates and the Fed has to look at this. Listen, it's transitory to a point. We saw prices drop when the market thought that there would be an end in sight for the Iran war, but then that reversed when the market started to realize that at least it wasn't imminent. Having said that, the Fed can stand around and say this is transitory, but the longer it goes, it's harder to make that argument. What do you think Kevin Warsh is going to kind of ultimately do about this?
Well, I mean, first things first, I do not believe it's transitory, and we've actually changed our investment positioning to assume $80+ oil for the foreseeable future now. And one of the things we've done is, when it comes to the stock selection, that we integrate into our portfolios, we own Union Pacific Railroad, because what we're seeing happen right now is you are seeing less freight move via truck on the highways because the cost of diesel is so high, and more freight is now moving via railroad. So that's probably the number one thing. Kevin Warsh, he's got a tough call here. I mean, this is not easy. The economy is doing incredibly well, but it's doing incredibly well because of AI capex. The consumer, it's kind of a bifurcated consumer. You've got a very strong high-income consumer, and you've got a weakening lower-income consumer. That's challenging. We'll find out more about that when Walmart reports in just a little bit. But from a yield standpoint, Jackie, probably the most important thing to know is that as yields have basically climbed from around 4% to 4.7-ish%. One thing that we've seen happen is the multiples in the stock market have stopped expanding. All right, so the market might be up, I don't know, 11, 12% this year so far. Multiples have stopped expanding, and when you look at a great company like NVIDIA, that forward multiple a few months ago was 31. It's down to 24 today.
Right.
So this has been an earnings-driven rally.
Right, which is very important to underscore that these companies are making real money. This is not like 1999. But, Jimmy, you had mentioned this $40 trillion mark for the national debt. That is, astronomical when you think about it. And when you think about borrowing costs as well, our interest expense is very high right now. I know that's something that the president thinks about and looks at. Investors also looking for greater returns on government-issued bonds. What do you think is going to happen from here? Because I guess without any resolution or any change, not knowing what the Fed exactly is going to do, I would expect the market to continue to march higher, Mark, to your point, on a good earnings picture. But there's still worry out there. And as long as there's worry and a little risk, you get these like little runs up and then a little, backing off, profit taking, whatever.
Well, we're definitely in a trading range right now, but as Mark was saying, I mean, this year has been all about fundamentals. So it's been earnings. I think jobs have been relatively flat, actually. And so it's helped companies with margins, which has been a good part of this earnings story. I think that that's a good thing. And investors are actually going outside of technology. I think the market's going to actually continue to broaden out if we can get yields to come down. But I think the debt situation is actually the biggest problem for long-term yields. That being said, I actually believe that if the war does get resolved sooner than later, oil will come down sharply, and I think inflation is really tame after that. So after the war is over, I'm a little bit more concerned about growth. If we can get the rhetoric to change from a hike to potentially no hike, and then maybe even like lowering rates, I think, again, we could get some animal spirits. We could get the market to go much higher and go towards the end of the year much higher than what people think right now even.
Yeah, and it all depends on what the resolution will be on the war, because I think one of the other worries for the bond market, along with the national debt and the interest expense, is how much will it cost to finance this war? And so that's being priced in to a certain extent if there's escalation. Switching gears for a moment, Mark, I'll come to you on this. Marvell Technology jumping nearly 10%, giving Google the option to buy over $12 billion in company shares. The stake is tied to chip purchasing targets through fiscal year 2033. The deal is going to include products that work alongside tensor processing units and helping AI systems process information storage and networking. What do you think of this?
It's another circular deal. I'm concerned. There's so many of these, it's actually exhausting. Essentially, Marvell is saying, if you buy my chips, you can now buy 6% of my company as well. That to me, that's one of the reasons that we've seen this broader sell-off in semiconductors and memory stocks over the course of the last few months. Marvell, right after Jensen Huang said that this was going to be a $1 trillion company, it was worth like $275 billion. Today, it's like $205 billion. So I think investors have become a bit exhausted at these circular deals.
I hear you, and that's part of the risk that's out there and things that people are thinking about. Jimmy, Lee, thank you so much for being here. Mark, of course, you're going to sit with me all morning long. We will be right back.